Now, this one's coming in fresh from one of you guys, our very own Financial Freedom Fam member, D. Wilson1234, saying, I work for FedEx, which is a bellwether for the economy, and we are losing volume. Wow. Now, we've already seen 2,000 retail store closures over the past year. Companies like Bed Bath & Beyond, Foot Locker, and Walmart have been shuttering locations left and right, and all just to save money and try and get an edge over inflation. But I don't know how long these places are going to last, especially since one Wall Street analyst is predicting that 50,000 stores will close over the next 5 years, guys. And if the economy falls into a prolonged recession, closures could reach 90,000. Smaller operations that employ 500 or fewer people are especially in danger. We're talking mom and pop stores, and this is according to UBS notes. Now, the US currently has roughly 940,000 stores, so this UBS prediction is basically saying that there will be a 5% reduction in stores by the end of 2027. Now, the forecast is particularly troubling because, according to the National Retail Federation, about 70% of retail sales still come from brick and mortar stores, meaning retailers could suffer greater losses once they start closing off places where people and customers physically stroll and shop. Now, I think a lot of us are already seeing this kind of thing happening. Just take a look at what's happening in San Francisco right now.
San Francisco's once bustling downtown streets still struggling to bounce back as retailers continue to flee.
The exodus continues.
A lot of retailers have been pulling out of the city.
In the past few weeks, Westfield announced it's giving up its prominent downtown mall location, while AT&T revealed it is closing its flagship store in the city. The hemorrhaging of businesses, a concerning post-pandemic trend for the city by the Bay. According to an analysis by the San Francisco Standard, nearly half of the non-service retailers in the city's Union Square district have closed since 2019.
Three factors at play here: the ever-growing prominence of online shopping, increased borrowing costs, and customers tightening their wallets due to inflation. Plus, you got people who are working from home, so these once thriving and bustling downtown areas, they're not necessarily doing that well anymore because there's less people actually downtown. Most people are staying at home. Not to mention, inflation is still putting a vice grip on Americans' household budgets. So basically, everyone has been buckling down and just kind of concentrating on everyday staples like gas, groceries, rent, clothes, and housing. And this is why things can wait, like clothing, electronics, and home furnishing stores. They're likely to bear the brunt of the closings in the coming years. Plus, more of their shoppers will opt to purchase those items online. They project store closures of 13,840 clothing stores, 9,190 electronics locations, and 4,090 furniture stores. Now, on the other hand, you have stores that you really need to see before you buy. They expect home improvement stores to lose only 210 locations and auto parts stores to stay steady. In fact, both job growth and year-over-year sales have increased at home improvement and auto parts stores. Two reasons why these particular sectors of retail likely won't suffer as many store closures in the future. So you might want to consider these when you're looking at stock market investments and different opportunities for, good return on investment in the future, kind of as a hedge against this upcoming inflation and recession. Then, of course, there's the matter of consolidation. Giants like Costco, Home Depot, Lowe's, and Target, they stand to benefit from most of the predicted store closures. They have the scale to keep standing in a recession. Not to mention, they pretty much sell the staples that people are buying. And when the smaller operators close, that would mean roughly $210 billion in retail sales would be up for grabs. This translates to $1,600 in annual spend per household that has the potential to shift to those leading retailers I just mentioned. Now, the retail industry may not like it, but it does look like people, particularly Americans, are starting to realize that 98% of what's on the store shelves they don't even freaking need. Now, out of the remaining 2%, 1.5% ends up in landfills sooner or later. But yes, congratulations to the 0.5% of retail purchases that actually last a lifetime. Now, I'm just wondering, whatever happened to the days where companies understood the perils of overextension, unsustained rapid growth, or any kind of basic concept of fiscal responsibility? But I digress. But let me tell you guys, it is good that we have our Financial Freedom Fam right here on YouTube. Otherwise, we wouldn't be picking up on updates like this. And if you haven't already, I highly recommend subscribing to the channel and dropping a quick like for the video and making sure that your notification bell is turned on. You definitely do not want to miss out on any future financial updates in the coming days, guys. They just keep getting bigger and bigger, you know what I mean? Oh, and hey, if you appreciate the work that I'm doing here, you can show your support by hitting that like button. Absolutely free, and it absolutely helps out the channel a lot. Not to mention, puts a smile on my face. Now, with what I've been hearing, I'm not all that surprised that they're calling 2023 the year of the retail apocalypse. something unpredicted in the history of the United States. Now, sure, when this is all recorded in history, it's all going to be seen from hindsight, but not really something that most people and mainstream media are seeing right here and right now. But people like us, we're paying attention. Major retail giants from Toys R Us to JCPenney, they have all toppled in previous years. And this year has been no exception. So let's go ahead and talk about these 5 prominent retailers that didn't make it. Let me know your thoughts on which company you think may be next to join this list. Now, let's go ahead and look at this list. Number 5, Christmas tree shops. They didn't quite make it to the next holiday season, you guys. After failing to secure a buyer in time to appease its lenders, Christmas Tree Shops announced the liquidation of its remaining 72 stores in July. They just couldn't meet the financial obligations, so that led to Chapter 11 bankruptcy filing in May. They tried reorganizing through bankruptcy, but I guess their liabilities ranging from $50 million to $100 million and only $50,000 in assets just couldn't quite balance out. So number 4, Bed Bath & Beyond. So both Bed Bath & Beyond stores and Bye Bye Baby stores faced closures after failing to attract buyers. Now, while their intellectual property found new homes, their physical stores just didn't make it. Bed Bath & Beyond's intellectual property was acquired by online retailer Overstock.com, and Bye Bye Baby's trademark and digital assets were sold to manufacturer Dream on Me. So number 3, Luna Premium Sleepwear. The well-known sleepwear brand Luna definitely went through the financial ringer, leading it to file for Chapter 11 bankruptcy in June. It was a whole mess of issues, including the reversal of the C-19 related trends, substantial losses in brick and mortar stores, and an inability to balance costs and revenues. But now, with their bankruptcy in the works, Luna is hoping to basically right-size its financial standing and continue offering stylish and comfortable sleep apparel. All right, guys, number 2, David's Bridal. Now, we all know somebody who's been to David's Bridal, am I right? But sadly, this is their second Chapter 11 filing in less than 5 years. The bridal retailer expressed openness to a buyer while preparing for potential liquidation. They just couldn't make it work with the post-C-19 environment with all the financial uncertainty that it entails. Last but not least, guys, Party City. So Party City, known for costumes, decorations, and party favors, they filed for Chapter 11 bankruptcy in January. The pandemic did a number on consumer demand for Party City's products, and that pretty much resulted in financial strain. Seeking a debtor in possession loan of $150 million, Party City aimed for an expedited restructuring to help out with their debt burden. A lot of experts have their own opinions about this, especially when it comes to which big company could fall next. 2023 ain't over yet, right, guys? But what do you think? Do you have any predictions of your own about which company could be next to go under? I'd love to hear from you guys. For me personally, just spitballing here, I think it's mostly just the stores selling the basics that's going to survive even just online selling. Most non-essentials will probably be left on the shelves. I hear a lot of people saying that we're headed for the second Great Depression. What do you guys think? Now, with the Federal Reserve raising interest rates to slow the economy and also to bring down inflation, some analysts think a recession is imminent. Now, of course, investors are still crossing their fingers that the Federal Reserve can get us out of the worst of it, but just in case our recessionary fears do come true, let's talk about ways to invest. Because the best investments during a recession may not be what you expect. Many investors make the mistake of becoming more conservative, but you would be surprised. Some financial experts say that the best long-term course of action is to actually become more aggressive during a recession, ramping up exposure to assets that may offer potentially higher returns in the future. And pretty much the rationale is very simple. After stocks have fallen, investors are paying a much lower price for the future growth of those businesses. It's the classic buy low, sell high that everyone knows, but that relatively few can actually practice because fear is so often getting in the way of making smart, intelligent investment decisions during a market downturn. Now, if you happen to be into stocks, a recession is a time to prepare for the rebounding in markets that's going to follow. So, of course, a recession is not just a downturn in the market, but it's also a slowing of the economy that could throw you out of work and cause other financial distress. So how do you balance these potential outcomes? Well, let's go ahead and talk about some investments to consider and maybe some you might want to consider avoiding. Now, you might have heard the phrase buy on fear and sell on greed, right? Warren Buffett has a lot of these different phrases like this, like buy when there's blood in the streets, stuff like that. But when markets fall, the first response for many investors is to basically sell everything and bail out of the market and try to stop the pain of losing money. But by discounting stocks in these moments, the market is actually increasing the future returns for investors who buy in. Great companies are well positioned to continue to thrive in 10, 20 years down the line. So a decline in asset prices temporarily usually means that your future returns are even bigger. So a recession, when prices are usually lower, could be the exact same time to score higher returns. So for starters, you could look into these different stock funds, right? So a stock fund, either an ETF, an index fund, a mutual fund, is basically a great way to invest during a recession. So a fund tends to be less volatile than a portfolio of just a few stocks, and investors are wagering less on any single stock than they are on the economy's return and a rise in the market sentiment. And a stock fund offers the potential for high long-term returns if you could stomach the short-term volatility. So look for well-diversified funds if you don't want the hassle and the risks of investing in individual stocks. Check out index funds based on the Standard & Poor's 500s. S&P 500? Oh yeah, that's what that means. Do that rather than trying to pick the winners. You own a piece of the entire market as a whole. And remember, the market has always come back from the downturns. So investing in the market itself is definitely something that experts advise. You could even buy into dividend stock funds and enjoy reduced risk that comes with diversification and also still enjoy some solid dividend yield. Now, obviously, none of this is considered investment advice. Always seek counsel from your own professional investment advisor. And I'm not a CPA and I'm not a tax advisor. Plus, if you buy while stock prices are lower, you'll enjoy a higher total yield. Real estate. So first, you could buy at a cheaper price than during a strong economy. Then when the economy picks up and consumers are more flush with cash again, like Mitch McConnell likes to say, the value of your real estate may rise. And if a recession does hit, then the Federal Reserve is more than likely going to lower the interest rate, and that would mean a much better mortgage rate. So then you could refinance in the future and reduce your mortgage payments significantly. Many investors did exactly this in the last few years. Now, banks are straight up hating on them for their 30-year fixed rate mortgages that are below 3%. I'm one of them. And as inflation rises now and in the future years, they're paying back the mortgage with cheaper dollars, making real estate a very attractive inflationary hedge. And if you're not ready to commit to any of these, there's always high yield savings accounts. Yes, cash can be a good investment in the short term, especially since many recessions don't actually last that long. Cash gives you a lot of options. You could spend it if you need to, for example, if you lose your job during a recession, and it allows you to just make a just-in-time investment if the stock market suddenly sells off or you find the perfect house later on. But there is a downside to holding too much cash. Inflation can definitely eat away at your money, and you likely won't earn enough interest to overcome it. So consider sticking your cash in a high-yield online savings account and keeping it there for strategic purposes. So if a recession does hit, it's important to focus on making the next right investment decision. And because the market is very forward-looking, prices and PE ratios will probably have declined some before it's clear that the economy is even in a recession. So investments that feel safe because their price has held up or even risen may not be especially attractive picks during going forward. I'm talking about things like bonds, company with a high debt load, and high-risk assets like options. Options are a bet that a stock price will finish above or below a certain price by a certain time. They're a very high risk, very high reward strategy, but the uncertainty surrounding a recession makes them even riskier. I think the overarching financial freedom fundamental during a recession is to keep your emotions in check. Making decisions from a place of emotion can totally derail your best financial plan. So just remember, we're working toward our own version of financial freedom, and that means sticking to a long-term plan, making sure we got an emergency fund and not constantly watching the market every 2 seconds, right guys? So if you made it this far in the video, drop a quick like for the video. Also consider subscribing for more content like this, and I'm gonna see you guys on the next one.